Hey, what is going on, guys? If you're new to the channel, welcome. My name is Nick, and today we're going to be talking about the top 3 stocks that I'm going to be buying heavily in 2020. Now, unless you've been living under a rock recently, you know that the market has been hitting all-time highs over the past few months, nearly every single month, with the S&P 500 surpassing 3,300. And although this is a normal occurrence, having the market hitting all-time highs, this doesn't provide investors with great value when buying individual stocks. And with my investing style focused more so on picking value stocks or dividend-paying stocks, it's been very difficult to find a good deal in the market right now. But I wouldn't have made this video if I couldn't find any stocks to buy right now, and so in this video you can expect stocks with either a great dividend yield or a value play, or both at the same time. So make sure to give this video a big thumbs up if you do enjoy these picks. It really helps with the YouTube algorithm and bringing these picks to more people. And if you haven't subscribed already, definitely consider doing so for more weekly videos just like this. And with that said, let's get into the top 3 stock picks that I'm going to be buying here in 2020. Alright guys, now the first stock pick that I have today is one that's been spoken about quite often here in the YouTube community recently, and that is Carnival Cruise Lines. Now I couldn't talk about this pick today without giving credit to Jeremy from Financial Education for giving me the idea on this stock pick. But in this video, I hope to provide you guys with a different perspective on Carnival Cruise Lines that you may not have heard before. So getting into it, Carnival Cruise Lines is the most popular cruise line in North America and operates 27 ships to destinations all across the world. Now, one thing that you do need to know about Carnival is that they're an entertainment-based business model. So people will go on cruises and go on holidays in good economic times, but then in bad economic times, the company might not hold up that well. And as we can see from their all-time stock chart performance, the company has done very well, steadily increasing over time. However, in the recession periods, they did not hold up very well, but then soon recovered after. And narrowing into the past few years, Carnival's performance really hasn't been that good, having dropped about 40% ever since their all-time highs at the beginning of 2018, and then over the past year alone, they've dropped about 30%. And a lot of the recent sell-off has been due to the coronavirus having perpetuated itself all the way from China to different areas of the world, which is a very serious crisis at the moment. In fact, some of Carnival's cruises had to be stationed at their ports because there was a risk of coronavirus being on the ships. However, I just see this as a buying opportunity and that the stock was way too oversold because I don't see the coronavirus actually taking over this business and rendering it bankrupt or anything of the sort. I think it's just a temporary thing. And that leads us into the company's current valuation, which is sitting at a current PE ratio of 9.8, with a 5-year average history of 17.5. And then if we compare that PE ratio to the industry average of 22.5, it's pretty easy to see that Carnival is pretty undervalued right now. Not only that, the company is expected to continue growing their earnings into the next year with a forward PE ratio of 8.7. So typically when you see that the forward PE ratio is lower than the current PE ratio, it implies earnings growth. Now we can also value the company based on their price to earnings growth ratio, which is the PEG ratio. And right now that is sitting at 1.3, and anytime that you find a company with a PEG ratio very close to 1, it's usually a pretty good deal. And finally, the last valuation metric that I like to look at for companies like Carnival with a ton of assets is their price to book ratio, and right now they're sitting at a P to B ratio of 1.14. Now this just means that the company is barely trading above its net asset value, meaning the value that they own in the ships, the office buildings, and every other asset in the company. And typically whenever you find a price to book ratio close to 1, like the PEG ratio, it implies good value. But of course, Carnival is a lot more than just a value stock. They actually pay dividends, and they have a strong track record of paying those dividends. Now I was able to find that the company has a forward dividend yield of 4.7%, and then a payout ratio along with that of 44.4%, so that is really solid. It's actually very rare to find a dividend paying stock with a yield above 4% and a payout ratio below 50%, and this company has both of those. And as I mentioned earlier, this company has been paying a dividend for a long time. However, they've only been increasing their dividend over the past 5 years because whenever a recession rolls around or some type of difficult economic time, it's not going to perform well because this is a wants-based business. So in the last recession, the company did cut their dividend. However, they did increase it very quickly after that, and then they have increased it even higher ever since. And I personally think that right now the dividend is very safe because of the payout ratio being below 50%, so they're paying out less than 50% of their earnings for the dividend. So given all of this great information on Carnival Cruise Lines, I did make a buy myself on February 7th. I ended up buying 38 shares at an average cost basis of $42.63 after the commission of $4.95. Although this only added up to about $1,600 of Carnival Cruise Line stock, I will continue buying into this stock provided they stay at about the same level or they drop further. Because I do think that they are severely undervalued right now and that they can be a really good dividend play as well as a value play. All right guys, jumping into stock number 2 today that I'm going to be buying in 2020 fairly heavily, and that is Suncor Energy. Now, if you aren't from Canada, you may not have heard of this company before because Suncor is the energy industry leader here in Canada. And just to give a full disclosure to you guys, I did work at Suncor in the past. I used to be a co-op student for the process engineering department over here in Alberta, and that's how I got to learn a lot about the company. Now, Suncor being the biggest oil and gas company in Canada, they have their facilities and operations all across the country. Now, the company has several upstream operations where they perform mining for bitumen as well as in situ drilling for oil. They also have downstream operations where they have several refineries all across Canada. And then they also have stakes in offshore operations where they drill for oil down below the ocean on the coast of Canada. Now, some of you may be wondering, why would I be recommending an oil and gas stock when oil and gas is clearly out of favor on Wall Street? Well, Suncor is incredibly focused on sustainability and reducing their overall emissions by having projects like their $1.4 billion cogeneration plant that will be coming up in the next 5 years. So knowing that Suncor is very focused on both oil and gas production as well as on sustainability and producing electricity and greener alternatives, I think they're going to do fairly well over the long term. So getting into the company's all-time stock performance, we can see that they have a long-term history of solid, consistent growth, even though it might be a little bit slow ever since year 2000, but the short term hasn't produced any good returns from capital gains when looking at both the 5-year and 1-year stock charts. And with the company's most recent earnings report not being the best, along with crude oil prices plummeting down all the way to $50 per barrel, the stock price has not done well. But again, with a company like Suncor, I just see this as a buying opportunity, so let's get into the valuation measures. Currently, Suncor has a PE ratio of 20.8, which is fairly elevated when compared to its history, as well as the industry average. However, the forward PE makes up being about 13.5. And with that expected earnings growth in the future, the company's PEG ratio is 1.2, which is very close to 1 and obviously shows some pretty good value there. Now, because this is an oil and gas company, I do also like to look at the price to book ratio because they have a ton of assets on their balance sheet, and right now their price to book is sitting at 1.4, and anytime it's below 1.5, it's generally a pretty good value. Now guys, along with the fairly good value that this company is showing right now, they also have a great dividend yield that's starting out at 4.8% for the forward dividend. And calculating out the associated payout ratio, we end up calculating 60.8%, which is still very good. Any payout ratio that's typically below 60% is something that I like to consider as a good dividend stock. And not only that, but the company's had consistent dividend growth with 18 years worth of consecutive annualized dividend increases. And what you can see here from the dividend chart is that the company didn't even cut their dividend in the 2008 financial crisis, nor did they even cut it in 2014 when oil prices struck bottom. So guys, last week I continued adding to my Suncor position that I already have, and I added another 40 shares at an average cost basis of about $39.06 in my new account, so I'll definitely have to update you if I do add more. And I do definitely plan on adding a lot more if the stock price falls below $38 per share, and I probably will build this up into one of the biggest positions in my portfolio. Because even Warren Buffett owns this stock, he sees the management is very good and effective, and I do too, so I'll definitely be adding to this position. Alright guys, now we're finally at stock pick number 3 today that I'm going to be buying in 2020, and this is a more controversial one that you may or may not have considered buying before, and that company is Boeing. Boeing is one of the two airline manufacturing companies dominating the market in North America, with its only competition essentially being Airbus. In fact, the duopoly of both Boeing and Airbus makes up 99% of the large plane orders in the world. However, as most of you would know, Boeing has been experiencing a lot of difficulties in their business model recently, with two of their star aircraft, 737 MAXs, crashing in 2019, being completely fatal. And ever since March of 2019, the 737 aircrafts have been grounded so that these incidents don't happen again until the problem is fixed, along with the production and deliveries of these aircrafts. And not only that, Boeing's bill has tallied all the way up to $19 billion just for the ramifications of those two crashes that happened in 2019. Now, over the past few months, Boeing has been working on a software fix to be able to fix these issues that were happening before. However, the company believes that regulators are not going to be signing off on their 737 jets until mid to late summer of this year. And because this is 6 months later than previously forecasted by the company, the stock price has not been doing well. Now, taking a look at their all-time stock performance, we can find that the company's done very well with a lot of growth leading up to their all-time highs in 2018. However, ever since, the stock price has flattened out and really hasn't had much growth ever since, along with a little bit of a decline over the past year. But even with this slight decline over the past year, the company's PE ratio is still found to be above 50 because of their negative earnings reports over the past few quarters. However, the company's forward PE is looking a lot better, being 20.4, with expected earnings per share in 2021 of $16.50. And that's because when the Boeing 737 production, delivery, and flights resume, the earnings should rebound simultaneously and get a lot better. Now, Boeing also does pay a dividend, so they've been paying this dividend for about 7 years, and the current yield is about 2.4%. And unfortunately, the company did break this streak this year when they only maintained their dividend at the same level as 2019, so we'll have to see where that goes, but I can't imagine them cutting the dividend. As for my thoughts on the company, I think that Boeing is a solid long-term play. They are the leading airline manufacturer in the world, along with Airbus. However, if you're trying to make money in the short term off Boeing, I wouldn't count on it. And although I don't currently have a position with Boeing, I would consider buying this stock below $310 per share, and then buy extremely heavily below $300 per share, because I think it will provide a lot of value once they start ramping up the 737 production again. I truly believe that this is only a short-term issue in the company, and that their earnings prospects are going to be getting a lot better once they figure it out. And as a value investor, these are the types of events that I'm looking for in the stock market when a company is punished in the short term, leaving investor sentiment very negative, but then once investor sentiment gets a lot more positive and the company turns around, that's where gains are made. And if you guys did stick around until this point, thanks for watching the video. Let me know what you thought about these stock picks down below, and if you do own any of these companies yourself. But with that said, if you did enjoy this video, make sure to smash that like button for me to support my channel. And then if you haven't already, definitely consider subscribing for more content on personal finance, business, and investing in the near future. And I will see you guys next time.